First of all, I have to blame Silicon Valley here.
Hello, and welcome to the Big5D Podcast, where we have lively conversations about the future of tech in Africa. I'm Charles Laughlin. I'm the editor-in-chief of Big5 Digital, and I want to thank all of the companies that sponsored our recent summit in Cape Town. That includes APSA Group, which is our lead corporate sponsor. Very grateful to them. Dialogue, a U.S. company that does really great research on AI adoption by small business. Inspire, a digital agency based in Cape Town that specializes in SEO and paid media. Networks Digital Marketing, which is a geospatial marketing agency, really does interesting stuff around how you can use geospatial data for digital marketing. Egregious, also a company in the geospatial space with location data, a really interesting data about Africa that is doing some really fascinating things that we'll get into more at another time. Pragmatica Digital Consulting, run by my partner in crime for the summit, Amanda Bester. And we want to thank Realm Digital for sponsoring a ticket giveaway. Zach George, I think many of you know, is the managing partner of Launch Africa Ventures. I believe he works out of this building, if I'm not mistaken. And we're going to just talk about kind of the state of venture in Africa and whatever else comes up over the next 20, 30 minutes. If at any point during this conversation you grab this and take a seat in the middle somewhere, and I'll sit on the other side of you. If at any point during this conversation you want to jump in, please just shoot your hand up. Amanda or someone will wander through with the microphone. And we'll take your questions as well. Okay, Zach, how you doing, man?
Good. Can't complain.
Okay. So
lots of familiar faces, at least a few.
So we've talked a few times on a podcast. We had you at a conference a couple of years ago. I think this is the first time we're doing this on stage format here, but I think most people in the audience probably know who you are, what Launch Africa is, but let's indulge those who don't with just a minute on who you are and what Launch Africa is. It's a VC, but what is its focus and specialty and niche, if it has a niche?
Yeah, so we launched about 5 years ago. I've been in South Africa for, funny enough, next week will be my 15th year anniversary of living in South Africa. I moved here after spending a decade on Wall Street at Lehman Brothers and Barclays, so doing what caused the crisis in '08. So I take a small amount of responsibility for that. I'm just kidding. I just work for them.
But did you come here for an event or something and never left? Wasn't it kind of like
the World Cup? Yeah, I was here
that's a good story.
The Vuvuzela Bafana World Cup in 2010. But what's interesting is, I noticed a lot of similarities between the startup tech ecosystem in Singapore, Indonesia, Brazil, Mexico, and India. And I said, why are there no accelerators, incubators, and VCs in Africa? This is 2010, so a good 15 years ago.
Not really all that long ago.
Yeah, it wasn't that long ago, yeah. And then eventually I said, as pretty as Cape Town is, you can't have a city as beautiful as Cape Town without developers, designers.
Without attracting a bunch of people,
A bunch of smart people. There's something in common between, Berlin, Lisbon, London, not so much.
That's a matter of opinion.
But cities like that attract people in tech, in design, in fashion, in music, etc.
San Francisco also, but Silicon Valley is dull as dirt. I don't know if anyone ever been there, but it's not that interesting.
But unfortunately, I wouldn't say there is no money in South Africa. It's just, I give talks on this often, but South Africa has this mentality of capital preservation, not capital creation. So if you have money, the first thing you think of as your run-of-the-mill South African family is, how do I protect my wealth? As a result, you dump all your money in the stock market. You give half of your money to Alan Gray and Coronation and all those guys in Newlands that will charge you hefty fees for picking stocks, right? 50 stocks in the JSE, or buying property. But real significant wealth creation happens through investing in private businesses, and that's why the average Rand billionaire in South Africa is a 65 to 70-year-old, family living in Stellenbosch. But the average dollar billionaire is a 29, 32-year-old techie in Silicon Valley.
That is not coincidence.
And the key thing here is looking at your attitude towards risk, right? And the attitude towards risk is so much more important than just capital. Like Stellenbosch, for example, is one of the wealthiest cities in the world on planet Earth per capita. But the risk attitude is shite. It's horrible. So when I came here, I noticed that Cape Town had all the ingredients to create a startup ecosystem similar to the Valley, Berlin, Tel Aviv, Bangalore, Shanghai, but it didn't have the right ingredients. So those ingredients were a combination of a risk-loving capital, for lack of a better word, incubators, accelerators, which do not exist, and then most importantly, which is something people forget, and I'm glad that we have a few corporate sponsors here, is corporate startup collaboration. And that was something that I realized very quickly. Without the banks, insurers, and telcos and retailers participating with startups, you could be building the best product on planet Earth, but if you couldn't get
Someone has to
distribution,
take it to market, right?
take it to market.
Yeah. So you said something interesting, which is about the idea of risk tolerance, and that the idea that wealth here is about preserving wealth rather than growing it. Maybe that's an inference I shouldn't make, but is that why? That leads to the question as to why, at least maybe it's changing, but so much capital that is in Africa is not from Africa. Is that why?
In certain sectors.
Okay.
I mean, if you look at, mining, infrastructure, oil and gas, real estate, agriculture,
Startup.
of course. But
Let's
if you
talk
look at
about
tech, I mean, our first fund was $36 million. Our second fund, we are targeting 50. We are sort of a third of the way there. Unfortunately, all our LPs, limited partners, are mostly from Switzerland, Germany, France, the UK, the US, and the Middle East. We have a few African investors, but it's folks in Nigeria.
Is that for the reasons you just stated, or is there a different reason for that?
I think it's the risk-return trade-off, right? And South Africa, where I live, is ironically the place where we have the least capital from. And the reality is, when we have these exits, and I can talk about them a bit later, the returns are leaving Africa and going to these other markets, right? I mean,
Hasn't that changed a bit?
it has changed a bit, yes. When I came here first 15 years ago, there was precisely zero capital from South Africa going into South African tech companies.
Okay, because that is the pattern that sustains a startup ecosystem.
Of course.
A mafia forming out of a big exit, right?
Yeah, of course.
Paystack or whatever.
So,
PayPal was an example.
You had the PayPal mafia in the Valley that Mark knows very well. In South Africa, you could argue that you had the what was the guy's name that went to space? The Shuttleworth mafia, the Paystack mafia in
That
Nigeria.
was the example that came to mind for
of
me.
course.
Yeah.
But the reality is, wealth creates wealth, right? The reason why Silicon Valley has done so well is the people that created companies had exits. Eventually, instead of buying, villas on the beachfront and buying Ferraris, they invested into the next generation of founders. So they saw themselves in the next generation, and so I hate this term giving back. No one's giving back. You're investing to create significance and success from the next generation. So the few entrepreneurs in Africa that have made a lot of money very quickly, and this is true of the Nigerians, the South Africans, the Egyptians, haven't understood this legacy thinking concept, this big picture thinking concept. In the Valley, most successful entrepreneurs become angel investors, become LPs in funds, and invest in the next generation of tech startups. So it's a question of changing your mindset versus doing what makes you rich tomorrow or next month or next quarter. And until that penny drops, it's very hard to make anything move forward.
So you say your funds are largely outside of Africa, the LPs, yeah.
Yeah, the LPs are mostly from Europe, the Middle East,
Right.
And the US, but our companies are in Fund 1, out of the 133 companies we invested over 4 years, about a quarter of them are from Nigeria. So we have a stake, for example, in Flutterwave, in Moove. Moove is, you know what Moove is, Kuda Bank. Some pretty iconic names in South Africa. We're big investors in Peach Payments. Some of you may know Peach Payments, Yoko, plenty of good French-speaking,
We've had a couple of those folks at this event.
Gozem, which is the Grab or Gojek equivalent, but in Benin, Togo, Cameroon, and Gabon.
Morocco, right? Africa, which I get those
not yet
mixed up.
Morocco, yeah.
They all have green logos.
Yeah, they do. They do.
Yeah.
But I think it's about just understanding risk-return trade-offs. Ultimately, there's only so many schools you can build, so many hospitals you can build, so many roads they can build. I mean, Mark Andreessen from A16Z famously said about 20 years ago, software is eating the world. Ultimately, if you don't invest in tech, you're a dinosaur, right? And there are some really smart tech founders all over the world. But who's backing them? Right? And the argument I always give to, I've had the privilege of talking to some very powerful C-suite executives in South Africa that are very anti-tech. And then I just asked them a question. Well, do you have children? Yeah, I do have children. How does your son or daughter get to work or whatever? Oh, he takes an Uber. Oh, how do your kids learn modules about coding or AI? Oh, they just use Coursera. And I just give them all these hints.
Does that change any minds? Or?
So you're consumers, but you're never investors. Mm-hmm. And the guys go, oh shit, I didn't know that I could invest in these companies. I'm like, no shit, Sherlock, you can.
Okay.
You just haven't.
Is that a good investor? Somebody who's that dumb?
I mean, so the kind of investors the kind of investors we like fall into three broad categories. One is we love ex-founders because they're operators, so they know how to build businesses and they understand how money can be put to good use to create similar businesses. Number two, we absolutely love executives at large corporates that understand distribution. So if you happen to work, I'll bring it back to South Africa, at ABSA, one of your sponsors, or Vodacom, or Sanlam, or Standard Bank, or Pick and Pay, whatever, you understand customer acquisition like no one does. South Africa specifically, I mean, it's funny that this is called the Big5 Digital Summit because Big5 is...
I've thought about changing this name 1,000 times.
No, but I'm just saying, it's super important because South Africa is governed by the Big Five. Okay. We have the Big Five insurers.
We knew that. That's why we named it this.
Right? It's Sanlam, Old Mutual, Hollard, Discovery, and Momentum. If you're number 6, I'm sorry, you're out.
Well, we weren't going to
change it to the Big 5 banks. It's Capitec, ABSA, FNB, Nedbank, and what's the last one? Standard Bank. If you're number 6, you're out. So literally, we are an oligopolistic economy. Okay. And all these 5 oligopolies in insurance, banking, retail, and telcos understand customer acquisition. And they're very protective about it. So if you're a startup that has an innovative tech solution, it could be a payments portal, it could be a peer-to-peer insurance platform, it could be a Shopify equivalent for SMEs, whatever you do, if you want to acquire customers and you don't have the liberty of raising million-dollar rounds to acquire customers through marketing, what do? You go and do a rev share, a JV, a license deal with one of these oligopolies. The key thing, though, is not to give up equity at that early of a stage in your growth, because then they'll just make you a lowball offer, acquire you, and Bob's your uncle. And there are a few examples here with the likes of, SnapScan and the Blue Bank and 227 and the Green Bank. I can't name them publicly here.
I've been reading some LinkedIn posts recently where they're telling stories like this of founders who just, bleed every drop of blood for the startup, and then they exit with $1 million, which sounds like a lot of money, but it's not in this scale. And, 10 years in, they walk away with really, they could have made more money doing something else. Yeah, I mean, that happens a lot more than is said, right? And how does a founder avoid getting into that position? Just talk about how that needs to change, because that shouldn't happen to somebody, but because it was probably their own fault.
Well, a couple of things. Silicon Valley has over-glamorized what it means to raise money as a startup, right? I can go out on a limb and say, from what I've seen in South Africa and Africa broadly speaking in the last 15 years, less than 0.1% of founders should go and seek venture funding because it is extremely expensive.
Right.
The cost of equity is technically infinity if you weren't sleeping in your business school classes. You should never, ever, ever, ever raise equity capital unless you absolutely have to.
Okay, define absolutely have to. What is the checklist that a founder should go through saying, we are at the point where raising equity makes sense and is necessary for us?
So first of all, equity should only be used for, broadly speaking, 3 things. Mm-hmm. Building a product that has a defined route to market, marketing, and your team. The reality is most founders will raise equity capital for things like working capital, for equipment, asset financing.
And where should that money come from? Bootstrapping?
Bootstrapping, or go and get it's
better
hard.
to get a bank loan than to raise equity. Yeah.
Banks don't lend against.
I know, but I'm just saying.
Unfortunately, banks don't. Banks need collateral for everything. So you need to look at alternative ways of. You can look at invoice factoring, reverse factoring. You could look at prepaid. I mean, there are lots of ways.
Anything but
equity, which is weird coming from a VC that
until you're at a point where you have a product that's viable, that's got product market fit.
Product market fit,
the most nebulous term. But.
Yes, and whose unit economics are getting increasingly better every month. So your LTV to CAC ratio, the lifetime value to your cost of acquiring customers.
So you can make the case that pouring gasoline on the fire will ignite the fire.
Yeah, and that is the only way. And secondly, startups need to really understand that you need to have multiple streams of revenue and not just one use case, which is typically I'm selling an asset, I'm getting money for it. And that enterprise SaaS revenue model, which is the holy grail of any VC's sort of
wish list, scalability of the subscription
is very hard. And I've said this before on this stage several times. Unfortunately, I hope I'm proven wrong, but our least successful. So the big five markets, sorry to burst your bubble here, are Egypt, Nigeria, South Africa, Kenya, and Ghana, and now increasingly Senegal. South Africa is so far the least successful market for us. And there's one main reason for it. The South African founders do not consider expanding outside of South Africa. And I'm sorry, we can't make money out of a 5 million person market.
But there have been
tax-paying market.
I know I've talked to a number of founders and they say, okay, we're off the ground, now we got to move into Nigeria. It's almost become a cliche. But that's as true as it's ever been.
I mean, like one of our portfolio companies, it's now public news, so I can say it, but Peach Payments, one of our top portfolio companies, they are a South African payment gateway, but they just did a Series A about a year ago at a close to $100 million valuation. They're now live in 4 African countries. Right. In fact, it'll be close to 7 post. They have now expanded through an acquisition into Cote d'Ivoire, Senegal, and Francophone markets. But the founder thinks big. But most South African companies remain in South Africa for years.
Is that because they think they're already in the biggest market, and why?
No comment.
Okay. But we have a question.
I mean, case in point, there are no South African tech startups where South Africa is the only market that are valued at more than $400 million for the largest economy in Africa.
Expansion is the only way to achieve scale.
The only one that's valued at $1 billion, people are going to say Time Bank, but the majority of Time Bank's revenue is not from South Africa.
Okay.
It's from the Philippines. And
I was going to say, isn't it Asian? Yeah, I thought it was.
The founders happen to be South
in Singapore, right?
Singapore, Philippines, etc. But building a business in South Africa and South Africa alone, very, very hard.
Amanda has a question.
Yeah, I've got a question. So I know we're discussing a lot about startups, but there's also a lot of SMEs and people that are wanting to scale up. And then there's also SME business owners that have had their business operating for many years, even just being in South Africa, not expanding anywhere else. But they might want to go into another business venture. And I think a question that's not commonly brought up or conversation is like exit strategies on businesses. Do you have any thoughts or insights to share on like what a good exit strategy would be? So, I get a lot of entrepreneurs, they love starting up businesses, but they don't want to keep same business.
Yeah, no, absolutely. Thank you. Well, it's two. Dying is one of them. Yes, of course. It depends. Is it exits for the founders or for investors? Because it's the answer.
Exits for the founders. So as a business owner, you start a business, you've grown it, it's now profitable, but.
Yeah, I think way too many. First of all, fantastic question.
Thank you.
To
start another new business venture.
Yeah, I mean, founders too often have no strategy when it comes to an exit, right? Unless you want to build a truly lifestyle family business that pays dividends and is profitable, which is perfectly normal and acceptable. don't expect to have VC type growth in that case. It's horses for courses, right? Assets for liabilities. But for an exit for that particular type of founder could very just easily be, I don't want to sell. I'm happy to just be profitable and pay dividends to myself, my shareholders, et cetera, et cetera. But if you're looking for VC type returns, you have to look at the biggest path toward exits in South Africa and Africa, which is corporate M&A. In fact, it is quite possibly one of the only options you have outside of private equity. Now, South Africa has a pretty decent private equity market, the likes of Old Mutual, Absa, Brait, Ethos, etc. But now we're talking 15 to maybe 20-year timelines. If you position your company to solving a pain point for a large corporate, the path to an exit or an acqui-hire is significantly shorter. Here's the flip side, though. The multiples that corporate Africa pays for SMEs, not that great, right? Just talk to our friends Naspers next doors. They will squeeze every last bit of juice out of your EBITDA, even if you have EBITDA, before they buy you, right? Like horribly low multiples. So the other alternative is, if you are Pan-African, or at least outside of just South Africa, I encourage a lot of founders to think of horizontal M&A. What does that mean? One of our top investments is Flutterwave. They're a $3 billion company. I like to remind people that Flutterwave is bigger than Nedbank, and Flutterwave is only 7 years old. But Flutterwave is an iconic fintech startup, and they are very acquisitive. They want to buy companies that provide complementary services to what they do. They're a payments infrastructure company, so they'll buy companies that are in credit, alternative lending, in peer-to-peer. So as a founder, you know that if you're pitching to a later stage founder that has VC money, they'll pay you a higher multiple of your revenue or EBITDA transaction volumes. But more importantly, if you learn to think long-term, you'd rather get stock in a high-performing, high-growth tech startup than just get cash. So the vast majority of horizontal M&A in Africa is stock for stock exits to later stage companies versus getting a small, pittance check from Sanlam or Standard Bank and getting bought out for nothing.
Just a quick example from the States. My brother is a small business owner, runs a music school. He was acquired by a private equity fund that was built just to acquire and roll up music schools. It's a great corporate corporate infrastructure, and they still operate as little small businesses. And that's happening across multiple verticals. Yep. There isn't an HVAC company in the States that isn't owned by a private equity at this point.
Yeah, of course.
So what
have we just gone through 30 minutes? You're kidding me.
No, don't worry about it.
We're just getting started.
Are there any questions in the audience?
My perception is that there are three answers you give to people coming in and asking for money. One is what we talked about earlier. You shouldn't be raising money, and here's why. 2, pass, just not interested for whatever reason. And 3 is you move forward. Is there a fourth?
So here's the kind of businesses that we love, right? And it's very, it's on our website, launchafrica.vc, check it out. We have an investment committee. We've so far backed 150 companies across 25 different African countries, and we've seen more than 6,000 applications in the last 5 years. Mm-hmm. The businesses that we absolutely love are businesses that have only come to us once they have product market fit, and they have at least one or preferably 2 enterprise clients that have run a POC or a pilot.
So it is now known you don't knock on your door without that?
No, don't knock on our door without it, right? So a proven pilot or a POC, preferably with someone like an Orange or an equity bank or a MTN or whatever. It does not have to be a commercial contract, but a pilot or a POC goes a long way, just proof of concept, right? The ability to think big picture and to be able to understand unit economics. So your marginal cost of acquiring a customer needs to be increasingly lower and lower and lower. And the take rates, what's the take rate? Is the the percentage of, excuse my very vulture-like terms here, but the percentage of money and juice that you can suck out of a customer.
That is a bit vulture-like.
It is a bit vulture-like, but everyone does it. Come on.
Yeah, of course.
That is, VCs love that. Right? So I'll give you an example. One of our top startups in Nigeria is a company called Omni Retail. They digitize inventory management systems for informal retailers.
What is that guy's name again?
Deepankar.
Yeah.
They were in the news last week.
Yeah.
They raised $20 million at a $100 million valuation. Incredible company. We invested in them 4 years ago. We were making good money on them. But why do we like them? They first offered a product that allowed informal retailers to remotely track their inventory volumes up and down, and through simple SMS and digital platforms, remotely order and restock their inventory from preferred suppliers within a certain radius. All done. Okay? And they charged a 2 or 3% fee for that. They perfected that, right? And then they went and said, now we can go and get third-party financiers to fund the purchase of those inventory. Second line of revenue. Eventually now they have 7 different lines of revenue, and they actually have a financial wallet, which is number 3, where all these informal traders use their wallet, not a mobile money account from MTN or Airtel, because they now have enough of a moat in order to do that. When they came to us, they had their first line of revenue locked in, and it was working, and they had paying customers. A VC will very gladly fund your expansion into multiple streams of revenue, provided you have very happy customers that are willing to part with their share of their wallet with you. So that I so rarely come across entrepreneurs that can think like that and talk to us like that. When you find those people,
put money into them.
Put money into them.
So my next question was going to be, what is... there used to be a lot of sort of founder-driven investment. I don't know, maybe that's wrong, but from what you're saying, that's no longer really the case, unless the founder is bringing you all of these metrics that you require. I guess that's the kind of founder you like, but it's not a founder-driven investment. Does that even happen anymore? Like, oh, this guy is so smart and so compelling and so much charisma, et cetera.
No. I mean, so we had those. We used to call them like what do you call them? Cowboy founders in the early 2020s. I mean, listen, I've
have you been guilty of this?
I've been through 4 recessions, so I know
probably one of those recessions.
One of those. What I would say is very few founders spend enough time doing proper diligence on funds. People expect VCs and investors to do enough of a diligence on them, which we should, but the reverse diligence almost never happens. So if you're a startup, I'm sure there are a few startups
Is that laziness, arrogance, lack of knowledge?
It's pure 100% unadulterated laziness.
Okay.
Nothing else.
Any one of those answers would have been fun, but yeah.
I wish it was arrogance. Okay. It's laziness. Okay. Because they look at VCs as ATMs. If one ain't working, go to the next one. Go to the next one. Okay. And you can see
it's just a numbers game. They think it's a numbers game.
It's a numbers game. Yeah. But the few founders that come to us, I've said this before, so please forgive me if this is repetitive, but it's so important. Founders that do enough research on you and your portfolio companies, and they come to us and say, hey, listen, I noticed that you made a really good investment into this company 3 months ago. We believe that we can solve this problem that this company has by providing X service. Oh, by the way, you're looking to expand into that market, we can serve. So they've done enough of a mind mapping of our portfolio companies across Africa. And it goes from being an individual IRR to a portfolio IRR, if people understand that.
Internal rate of return.
Correct, but for the portfolio. Mm-hmm. So we will often, as a fund, say yes at our investment committee to a standalone company that may not make us a lot of money individually, but enhances the portfolio IRR because of synergies. I'll give you one quick example, and then we can go to Q&A. We backed a company in Nigeria 4 years ago called Be Free, and all they do is they use AI to improve collection ratios from both brick and mortar lenders and digital lenders. Right? Everyone loves to lend money, from Fair Money to Carbon to Branch to Taller to here in South Africa, Lula and Better Bank and all of these. No one likes to collect, right? It's a shitty job. Yeah. So what do these guys do? They use AI to improve or to look at the subtle balance between someone's ability to pay and their willingness to pay. And they use everything from social media to radio,
TV. Is this the new credit score? In a way?
It's sort of, it's getting to that.
Okay.
So they serve all the major digital and analog lenders. Now, we invested in them, and if things go well, we'll maybe make 4 to 5 times our money. However, guess who we are using to help all our digital lenders in our portfolio? Be3. So they've improved the collection ratios of all the digital lenders.
So they're helping all your other investments.
They're helping all other companies. Okay. So even if we make just 2x our money on Be3, we'll make more than that. Mm-hmm. The portfolio is benefiting. Okay. But when the guy walked into our office, our virtual office, because I went to Nigeria, he didn't come here, he basically said, this is how we're going to add value to you and your portfolio companies. And here are some...
And they knew all your portfolio.
They knew all our portfolio companies.
Okay. So this was not a lazy founder.
It wasn't a lazy founder.
Okay.
Right? But you don't meet founders like that often.
Okay, that should be surprising. Maybe it isn't. But audience, raise your hands. Otherwise, I just keep asking questions. That's kind of how this works. Okay, here we go.
I knew Mark was going to ask a question.
Yeah, well, you mentioned AI. It's like a trigger word. There's a big shift in the world where small companies starting up are using AI now, vibe coding, to actually stay small and use AI in their business.
Yeah.
Our company actually provides business and tech tools to help small companies with AI. I'm just curious to know, in Africa, are you finding that there's a shift happening quickly in this area?
Yeah, big time. Specifically in 2 markets, in Nigeria and in Francophone West Africa, to Senegal. So honestly, Mark, I know of your company very well. You should totally provide that to some of our portfolio companies. Vibe coding is all the rage right now, but absolutely.
So I'm going to ask you the question I ask everybody who is an investor or a founder, and it's the Sam Altman billion-dollar unicorn AI startup. Not a startup of an AI company, but a startup of a company built on AI. And how instead of 10 people, you have 1. Do you see that happening? Is that a vision that was premature or off base? Or do you think that's, one person will scale a company that took 10 people 5 years ago?
Yeah, I get asked this question a lot. Is AI going to kill jobs in Africa?
That's a boring question. I think it's a little more interesting.
I don't think so. I think what you're going to see is a shift in priorities where people are going to start learning not just how to code, because Mark will tell you this, coding will become obsolete very soon. It already is becoming obsolete.
Almost a no-code world already, right?
Correct. Mm-hmm. But we're going to have a shift in jobs from, dare I say, low quality, but from low quality jobs to higher quality jobs. And there's going to be a shift. I give the example of, before Henry Ford built the automobile, every flippin' horse rider was like, shit, I'm going to lose my job. No, you just retrain your skills into being a chauffeur. It's just a bad example, but you see where I'm going with this, right? So AI is just creating...
AI killed the buggy whip industry.
It did. But you just transfer your skills, right? So I don't think... Also remember, Africa has the world's largest population from a continent perspective, right?
And age... demographics are...
Yeah, when I say largest, as in not obviously compared to India and China, but from a population growth perspective, with the fastest growing population in the world, we also have the world's youngest population, right? Our population in Africa, on average, is 18 years old. And I happened to have a conversation with the Ethiopian guy who runs the WHO, at least used to run the WHO. Africa is going to surpass Asia from a population perspective by 2060. That's not too far away from now, right?
That, in demographic terms, that's tomorrow.
It's tomorrow.
Yeah.
But what's interesting is our average age is today 18. It's going to trend towards 15 So we're getting even younger, the average age in Africa, by 2050, 2060.
Which tells me AI is perfect for founders
Well, this is
in
the
Africa.
thing. Absolutely, this is the thing. I mean, and young people are the most digitally savvy.
Right.
And transact entirely through their mobile phones. So Africa, I'm going to end with a few thoughts here. For those of you that weren't sleeping in Econ 101, an economy that grows is an economy that spends. I'm going to repeat that for those in the back. An economy that grows is an economy that spends. An economy that saves will never grow. Japan is fucked. I mean, I'm calling a spade a spade. An economy that saves is literally is a precursor to a collapsing economy, right? This is why, as much as we hate the Americans and Trump and all of that, some of you may not, but America spends. When you spend...
Like crazy.
I mean, yeah, it spends, and then the economy grows. Now, part two is Econ 102, is producers versus consumers, right? The old analogy was always, if you produce, you will grow. About 25 years ago, that basic theory of economics was flipped on its head from the tech revolution and the gig economy. Economies that consume grow faster than economies that produce. Now, Africa, for several centuries, was always a net producer. We produced coffee, cocoa, beans, rice, minerals, everything, right? But companies that produce don't grow. Companies that consume grow. Why is this important now? Because Africa is slowly but surely moving from net producer to net consumer. Why? One reason is copulation.
Of course.
I said copulation, not population, but copulation leads to population.
That's the necessary element of population.
Yeah, you think so, yeah. But so we have more consumers. Secondly, because the average age is so low, the consumption of digital content is higher per capita in Africa than anywhere else in the world, right? I mean, my co-founder Junaid happened to meet Phil Knight, the founder of Nike, at an HBS event a year ago, and he was saying, Nike cannot sustain itself by selling shoes to middle-aged families in Cape Cod. We're selling shoes for the next 50 years, even if we exist then, to 20-year-olds and 15-year-olds in the streets of Kinshasa. So Africa is moving from a production economy to a consumption economy. Therefore, you need to be building tech solutions for your consumers that are literally at your doorstep. And that's everything. That's music, that's art, that's tech, that's everything. So once you understand that point, if you're an investor that looks at sort of future-based thinking, you should be looking at Africa as a consumption of your products, be it digital insurance or e-commerce platforms or AI for better healthcare services. Ultimately, if your consumers are here, you shouldn't be thinking, where are my markets? Which is also why it pisses me off when South African founders, once they have 10,000 customers in Rondebosch, they want to start saying, oh, I want to go to Perth now, or I want to go to London. Like, no, you've got the whole fucking continent, right? Like, look at where your consumers are.
Amanda, can we, we'll take this question and then we're going to have to wrap up, unfortunately.
Just want to say I love all of this. It gets me really excited when people talk as directly as you do about investment. So I often joke and say I'm a failed founder. Started three businesses, sold 3 businesses, didn't go completely broke. Lots of life lessons, so I'll take that. My question is kind of like with people who you've mentioned have these ideas. You mentioned cowboy founders, all those kind of things, right? The black book full of dreams and ideas that you sit there with. What advice do you have for makers and dreamers in terms of founding, starting, the whole thing, the dreamers and the builders? What's your advice to them?
Yeah, it's a tough one. I mean, because the journey of a founder is a hard journey. It's the what's that Greek famous journey? Odyssey. The Odyssey. The Odyssey. Yeah. What I would say,
Don't test my literary knowledge.
Gosh, yeah, it was 20 years ago. One thing I would say is learn to sacrifice basis points. I'm an ex-Wall Street trader, so I think basis points, but margins for volume, right? So if you're a founder that has an amazing idea in your a set of ideas in your black book about changing the world, whatever your industry is, go and seek out people that have better networks and resources than you. For that, you require a certain dose of humility, which I've seen is quite rare in a lot of founders, right? Seek them out as advisors and mentors and offer them a portion of the pie. Why is this important? Is because people always talk about, oh, I'm a big fish in a small pond, I'm a small fish in a big pond. But the reality is in South Africa and markets like this, most of us, most of us are whales in puddles. That's what we are. We have a huge stake in a very small market, and it's pointless. So what I would say is seek out people with connections, networks, distribution networks, super important, connections to corporates that will listen to what you're doing and allow you the freedom to test your product, whatever you're building, with them in a safe sandbox, right? And offer them a piece of the upside early on. Very few founders have the humility to do that because they want to keep everything to themselves. And be open to the possibility that even though you physically live in Cape Town, the right market for what you do may be somewhere else, in Africa, in Asia, in Europe, it doesn't matter. But the humility to learn that you need to get, not like-minded, but sometimes people that disagree with you, but have disagreements that are justified. Super important. I actually don't like founder teams that have 2 or 3 founders and they all sing from the same hymn book. Because you start believing your own, it's called confirmation bias, right? Yeah. I actually prefer founders that disagree, but...
Do you find it better if founding teams kind of met to form the company versus grew up together and went to school?
No, absolutely. I mean, if you look at Y Combinator and Techstars and all the big accelerators, a lot of them have what do they call these events? Where you actually matchmake founders, like
right.
CEO meets CTO, CTO meets CEO, etc.
Right. You need a salesperson, a tech person, and someone else.
An operator, yeah. But you have to know the subtle art, and these are the words of Obama. I used to campaign for him like 15 years ago. The art of being able to disagree without being disagreeable. Right? You're from Chicago. You'd know this. Yeah. But that is super important. Like, surround yourself with people who disagree with you for the right reasons and not disagree with you for the sake of disagreeing with you. Some of these teams are some of the best teams we've backed. Yeah.
I'd like to keep this going, but we have to stop.
It's all right. Yeah, I mean, ask what the audience wants in there.
Yeah. Zach, thanks a lot. Everyone, please thank Zach with me.
First of all,
thanks for joining the Big5D Podcast. The show is written, hosted, and produced by me, Charles Laughlin, Editor-in-Chief of Big5 Digital. We hope you enjoyed the show, and please like, subscribe, do all the things to get involved with this podcast. If you're interested in sponsoring or being a guest on a future show, please write to us at info@big5digital.org. Thanks, and see you next time.